Good afternoon and welcome to this month's Employee Benefits Compliance webinar. I am Jenny Bideau with Assurex Global and thank you for joining me here today. Today, the Benefit Comply team will discuss annual limits for HSAs, FSAs, and dependent care accounts. As we are getting started today, since it is annual enrollment season for many companies, I'd like to begin by asking you, our audience, a polling question on the topic. You'll see a poll launch on your screen here in just a moment, and you'll note that we have two questions. We are curious what method or methods your employees use to enroll in their benefits programs. And then secondarily, we're also curious about the methods that you use to communicate information to your employees. Please take a moment and select all options that apply to your organization for both questions. And as you are submitting your selections, I'd like to extend a special thank you to your local insurance benefits advisors and consultants who are partners of Assurex Global for making today's webinar possible. And we do welcome your questions today. So if you have questions at any time throughout the presentation, please submit them using the Q&A function at the bottom of your screen. We do also record these sessions, and a link to the recording, as well as a copy of the presentation slides, will be available from the benefits advisor who invited you here today. And I will also drop a link to the presentation slides in our chat section in just a couple of minutes. I'm going to let the polls stay open here for just another few seconds to capture folks who are just joining us. As those responses come in, we have asked these questions actually over the last several years, probably not surprising to you. As far as enrollment methods, online, so mobile or computer-based enrollment has been the most popular for a number of years, but the kind of the percentage that we saw using that has fluctuated. So curious to see where that lands this year. Sneak peek shows us that we took a jump as far as how many folks are using that method this year as opposed to last year. All right, let me share these results out with everyone so you can kind of get a peek at how your peers answered, and then we'll get into today's content. All right, so you should be seeing there on that first question, 85% of you said that you're using online or mobile enrollment. That's up again about 5% from what we saw last year. As far as that second question, heavy reliance on kind of that website or mobile apps. Lots of you still utilizing meetings and benefits fairs, printed materials. Certainly, communicating a number of different ways is the most effective way. So we're seeing that in the results as well. So thanks as always for providing your thoughts and your feedback on those polls. Do note I have one final poll during my closing comments. But for now, we'll get into today's content. Joining us from Benefit Comply, we have David Flotten, Senior Consultant, and Delaney George, Consultant. So Delaney and David, I will hand things over to you.
Thank you, Jenny. All right, so today we are tackling the timeless topic of annual limits. Just a quick agenda. Oh, thank you for sponsoring today's webinar, our partners. And just looking at our agenda, we're going to do a quick introduction to annual limits as a whole, look at some of the nitty-gritty details for each of the account types and what kind of limits apply there. And then the real, I think, meat of the presentation will be in the examples, because that can just be the best way to really understand how these limits work, is seeing real life examples. So diving in, introduction. So the IRS has multiple vehicles, right, for people to get tax favored benefits. And FSAs and HSAs are two of those vehicles to get reimbursed for qualifying medical expenses on a tax favored basis. DCAPs may be used to reimburse qualifying childcare expenses on a tax favored basis. And so we have all these vehicles, but the IRS has limited how much an individual can really benefit from them on a tax favored basis. And you might be asking yourself, how many ways are there really to cap something? How many different types of annual limits can there really be? And the answer is really plenty. The IRS was quite creative in just varying the different ways that they apply them. And this slide just demonstrates the different traits that can vary. So does the limit apply on a calendar year basis or plan year basis? Does it apply to just the employee, the individual, or does it consider the household? Is prorating ever necessary when you have an annual limit? And then what is it actually limiting? Is it limiting the employee contributions through salary reduction? Does it consider the employer contributions, or are we limiting really the reimbursements, not necessarily the contributions? So that's what we'll be looking at today. So we've got FSAs, HSAs, and DCAPs. Are we missing anything, David?
Well, there is the elephant in the room, or not in the room, I suppose, as the case may be, which is HRAs. That's the other most common account-based plan that we see out in the benefits world. And the reason we're not going to cover them today is because there actually aren't any legal limits. The IRS has not put any limits on how big an HRA can be. So that limit, to the extent there is one, and they almost all have one, is set by the employer. It's one of the reasons employers like HRAs is because they give a lot of flexibility, and this is one of those areas of flexibility, which is how much money do I want to make available. There are a couple of small exceptions. Accepted benefit HRAs and QSARAs do have legal limits as to how big they can get. But for the most part, HRAs, you set those yourself. So go look in the HRA plan document. And that's about all we're going to say about those for today.
Yeah. Luckily, the IRS wasn't very creative on that one. So. All right, let's jump into the details here. So annual limits for health FSAs. First of all, they apply on a plan year basis versus a calendar year basis. And the way that works is the applicable limit will be the one that is in effect on the first day of the plan year. So you see, I have the salary reduction limits that the IRS issued for FSAs. So a plan year beginning in 2024 can be maxed out at 3,200. And this would apply to both limited purpose and general purpose FSAs. And the limit would also apply per employee, but also per employer. So someone with multiple employers can have multiple maxed out FSAs. Somebody could theoretically be contributing up to 6,600 in FSAs in 2025 if they have two employers with FSAs with a 2025 plan year. They apply only to the employee contributions through salary reductions. Employer contributions are not limited by the IRS statutory limit, but employers need to consider accepted benefit rules when they think about the contribution, because health FSAs need to maintain accepted benefit status. Otherwise, they're going to run into issues with ACA compliance. So employers need to consider that when they do set an employer contribution amount. Short plan years for FSAs do have to be prorated. That's not just recommended, it is required. Then mid-year enrollees, though, do not have to be prorated. It's not required, but an employer could choose to implement that by design. If you have a new hire, employers could, that's one way that they could limit their own exposure when they offer an FSA by prorating mid-year enrollees.
So flipping over to dependent care accounts, dependent care FSAs. So here we've got the actual limit there. It's the bottom. It's $5,000. This is one of the few limits that does not index for inflation. It does not change from year to year because it's built into the statute. And so it can't change. The IRS can't change it. It would take Congress to change it. So this $5,000, those of you who have kids know that doesn't get you very far, but we're stuck with it unless and until Congress decides to up it. Now, as Delaney said, how many different ways can you measure annual limits? Well, here's one difference. FSAs we measure on a plan year basis. DCAPs always we measure on a calendar year basis, regardless of what the plan year is. You can have a dependent care account whose plan year runs July to June, for example, but the $5,000 limit is always going to be measured calendar year. And that causes some problems if you do have a non-calendar year DCAP, as we'll see in our example. Another important distinction here, this $5,000 is actually a household limit. So if you have two spouses, both who are working, and each of their employers offers a dependent care account, they can contribute no more than $5,000 between them. They can split it up however they want to, but they don't get to do $5,000 each. They have to coordinate, make sure that they don't go over the $5,000 limit for the household, because of course you as the employer are going to have no idea what your employee's spouse did with their dependent care account. So it's kind of up to the employee to make sure they monitor that. The FSA limit doesn't apply to employer contributions. It does apply to dependent care contributions. Now most employers don't put money in DCAPs, but if you do, that will be part of the $5,000 limit. It's reducing how much of their employees' money they can put in themselves. So it is $5,000 total between both employee and any employer contributions. Short plan years are actually not required to prorate for the dependent care account, but we would recommend it. And mid-year enrollees, you're also not required to prorate it. They can put the full $5,000 in if they join mid-year. But again, we would recommend that you do prorate it. And again, we have an example that's going to illustrate why that can be a problem if you don't.
Mm-hmm. Finally, we have HSAs, my personal favorite. They do apply on a calendar year basis, like the DCAP, regardless of what the underlying HDHP plan year will be. The HSA will always be measured on a calendar year basis. The limit applies per employee or per account holder. Just really got to think about the person that is attached to that HSA. And then it will apply to employee and employer contributions. And I guess whoever is contributing to the HSA, that limit will apply to those contributions. Short plan years and mid-year enrollees are required to prorate, and that's kind of a nice segue to look at the monthly contribution rule, which kind of describes why the prorating is going to be required. And that is because an individual may contribute up to 1/12 of the applicable annual contribution limit for each month in a calendar year that they are HSA eligible. Now, HSA eligible means, covered by the HDHP, no disqualifying coverage, and not anybody else is tax dependent. And that the HSA eligibility measurement is taken on the 1st of each month in the calendar year. So somebody has HDHP coverage January through June, then they can contribute up to 6/12 of their applicable contribution limit. There's an exception to that, though, to the monthly contribution rule, will be the full contribution rule or last month rule, where if somebody has HDHP coverage or is HSA eligible as of December 1st of a calendar year, they can contribute the full annual contribution for that year, even if they were not HSA eligible through the whole year. They can contribute that full contribution if they maintain their HSA eligibility for a 13-month testing period. So through the following December 31st. So somebody is HSA eligible as of December 1st, 2024, but they just enrolled in their HDHP. They can contribute the full 2024 contribution if they stay HSA eligible through December 31st, 2025. So, and then we also have a special rule for married individuals. So I said, the limit applies per employee. That's true for the most part, except for this special rule for those married folks, where if both spouses are HSA eligible and at least one of them has a family level HDHP coverage, then the spouses must share the family limit. It doesn't matter how they split it, if it's 50-50, 90-10, whatever, but between the two of them, they can't go over that family limit then.
We should mention one other thing before we leave that slide too.
Yeah.
There is also, if you are age 55 or older, you can in fact make an additional $1,000 catch-up contribution on top of the basic single and family contribution limits that are on that screen. So again, we'll have an example that covers that.
Yes, thank you, David. Yep. And that's it, even in addition to the special rule for married individuals too, really. So in summary, this just takes, some of those quick characteristics of each annual limit, just to compare and contrast. These are the quick hits in terms of what makes them different from each other, right? Okay.
Couple questions before we go to our example.
Yeah.
So somebody's asking, does the 13-month rule testing period only apply for December 1st or mid-year enrollees as well?
And it applies for mid-year enrollees who have coverage as of December 1st. So I kind of explained it as beginning December 1st, but that's not really true. It's anybody who has HDHP coverage or is HSA eligible as of December 1st, regardless of when they would have enrolled throughout the year, could then make that full contribution if they maintain HSA eligibility for the next 13 months. So,
and also keep in mind, it's only relevant if they want to contribute more than the 1/12th rule would allow.
right.
We don't have to worry about the testing period if they're going to stick to the 1/12th prorated limit. It's only relevant if they want to go over that up to the maximum limit.
Yeah.
Is that contribution each spouse? So the $1,000 catch-up contribution, can each spouse do that, or is it $1,000 for the family? And it is $1,000 per person. However, you can only put your catch-up contribution into your own HSA. You cannot put your spouse's catch-up contribution into your HSA. They would have to go open their own HSA in order to take advantage of that. And again, we'll have an example on that coming up.
Yep. Okay.
I think a lot of the rest of these, I think we actually have examples coming up. So why don't we jump into those and then we can go back and see if we missed anything.
Sounds good. All right. Our first example is for health FSAs. Denise works for employer A, who has a calendar year FSA. Denise elects the full contribution limit for her 2025 plan year, the $3,300. But Denise leaves employer A and is hired by employer B in May of 2025, who also offers a calendar year FSA. How much can Denise contribute to her health FSA under employer B? The answer is $3,300, unless employer B has chosen to prorate mid-year enrollees. Again, the mid-year enrollee prorating for health FSAs is not required. It's a plan design choice. I also want to point out that even if Denise was still employed by employer A and just gained another employer in 2025, she'd still be able to contribute that $3,300 pending any plan designs that would prevent her from that. So we'll take that same fact pattern and switch up the plan years a little bit. Employer A has a November to October plan year with an FSA, and employer B has May through April 30th. So how much can she contribute to her health FSA under employer B? And employer B, it's still $3,300, but for employer A, it's going to be $3,200 because that plan year started in 2024. And that is the relevant limit that will then apply for that entire plan year, even though the majority of the plan year is in 2025 because it began in 2024, the 3,200 limit is what will apply. Okay, one more twist for you is the same facts, but employer B has a short plan year from June to December. So how much can Denise then contribute to her health FSA under employer B? And it would have to be a prorated amount, right? Because even though mid-year enrollees aren't required to be prorated, under a short plan year, they do have to be prorated. And did I do the math wrong here? June, July.
7 months.
So okay, it is 7 months.
Yep.
Okay, that's why I went to law school. Sorry. So the health FSA, it was a short plan year of 7 months. So 7 out of 12 months times the 2025 limit would be 1925 that she could contribute to her health FSA. Yeah, in addition to the 3,300 that she would have contributed to employer A's FSA.
Do keep that in mind. We see short plan years if people are trying to change, maybe they have a non-calendar year and they want to go calendar year. It's not uncommon to do a short FSA plan year to bridge the gap there. But you do then have to pay attention to this, that the maximum contribution limit does have to be prorated in that circumstance.
Mm-hmm.
All right, let's do some dependent care examples. So Susan works for employer A, offers a dependent care account on a calendar year plan. So for the 2025 plan year, how much can Susan contribute to her DCAP? Nice and straightforward. It's $5,000. It's been $5,000. It'll keep being $5,000 until Congress says otherwise. Same basic facts, but Susan's spouse Charlie works for employer B, who also offers a calendar year dependent care account, and Charlie contributes $4,000 to his dependent care account with his employer. So the question now becomes then is how much can Susan contribute to her own DCAP? And if you recall, this is one of the limits that's actually a household limit. So Susan and Charlie can only contribute $5,000 between the two of them. So since Charlie already used $4,000 of that, Susan can only do $1,000. And we run into this all the time, that there's either some miscommunication or it's a misunderstanding as to who's doing what, or maybe just no communication, and both spouses end up electing $5,000. And now they've got a problem because there's too much and they're going to have to fix it to try and get some of the money out. Obviously, again, you as an employer can't really do anything to monitor this. All you can really do is educate your employees just to remind them that it is a combined limit between themselves and their spouse, or another employer for that matter. All the same facts as above, but employer A's DCAP is on a June to May 31st plan year. So here's where it starts getting technical and a little tricky. So the question is how much can Susan elect to contribute? Well, for that plan year, she can elect to contribute $5,000. However, same facts as above, $1,000, because we're looking at Charlie still. But here's the kicker. The DCAP limit is actually not technically a contribution limit. It's technically a spending limit. So even though this plan year is running June to May, and she can only elect $1,000, that's really only for 2025, is what we said here, right? So in other words, for 2025, because Charlie put in $4,000 in his calendar year plan, she can only put $1,000 in for June through to December. If there's an event that lets her make a new election in January, even though that's the middle of her employer's plan year, she can do that because, again, the $5,000 is a spending limit by calendar year.
Mm-hmm. Mm-hmm.
Now, it's really these off calendar year plan years for dependent care account that cause the problem. So we're going to do a couple of examples to illustrate why it can get really messy and why we always recommend that dependent care plans always run on a calendar year basis, even if all your other plans do not. Okay. So Ruth gets hired January 2024 by employer A, who offers a dependent care account that runs on a July 1st to June 30th plan year. So she enrolls in her dependent care account upon hire in January, and she elects the full 5,000. So we're in the middle of the plan year, but she elects the full $5,000, which legally she's entitled to do. And she spends all of that before we get to June. Not too difficult. So she spends all $5,000. So now we get to the start of the plan year in July 2024. How much can Ruth contribute to the DCAP for the upcoming 2024 plan year? Well, she can elect $5,000 for the coming plan year, but she can't actually spend any of that money until 2025 because she's already gotten $5,000 of dependent care benefits out from the back half of the plan year earlier. So she can elect the full $5,000 for the next plan year, but the employer should have mechanisms in place, so the TPA, that she actually can't get reimbursed. So she's potentially having money coming out of her check that she can't touch, which is the next question, which is how much should be deducted at the beginning of the plan year? Well, if we do what we normally do, which is take that annual contribution and divide by 26 or 24, depending on how many pay periods you get, or by month, as we calculated it out here, you get $416.67 a month. But like I said, she can't spend any of that for July through December. So she's having several $100s come out of her check every month that she can't actually touch or use. Now you can question, so should we delay? Maybe we don't start the deductions until January, since that's the first she can use it. Maybe. But then, that's going to be a lot more that comes out at the back end of next year. So this, there's not necessarily one right answer here. Most people, I think, would just we're going to deduct as normal, even though you can't spend it. And it's just going to sit there until you can spend it. But, what happens if Ruth gets laid off in November and she's had all this money deducted from her check and suddenly she can't use it because she's terminated and all that gets forfeited? Not to mention, even if everything goes smoothly, she's now on this endless cycle that she's spending all her money in the first 6 months of the year and can't spend any in the back 6 months. Now, we could fix this if we didn't let Ruth elect the full annual contribution amount when she was hired. If we told her, you can only elect 50% because you're joining 50% of the way through the year, that would have solved that problem there. But it doesn't solve all the problems. So, for example, the next one, Ruth works for employer A, offers a dependent care account with an April 1st to March 31st plan year. Ruth enrolls for the 2025 plan year and elects the full $5,000 contribution. Now, one of the things with the dependent care accounts is you can only get out as much money as you've put in. Now, most people will get the money out as fast as they're putting it in, right? The money will come out, they'll submit a bill, they'll get it back out again. But you don't have to. So what happens in this case is Ruth kind of holds on to her dependent care bills. And so in November 2025, she submits a claim for $3,000, gets reimbursed. Then she saves them up again and submits a $2,000 claim in March of 2026. And then, of course, we get back around to this April 1st plan year for 2026. And again, we get the question, how much can she contribute to the 2026 plan year? And again, the amount she can contribute is still $5,000, but how much of that can she spend? Well, for the rest of 2026, she can only spend $3,000 of it because she's already spent $2,000 in March of 2026. So it becomes really tricky. Or it can become really tricky. Most of the time, I will admit everything ties out and it's easy. But you get into these weird scenarios where you have to try and explain to employees why, yes, we're taking your money, but you can't actually spend it yet when you've got a non-calendar year. So this is one of those areas, normally we try to get, sync up all the plan years as best as you can. And with an FSA, I would highly recommend that match your medical plan year. This is the one exception, though, because of the difficulties it causes. It does make a lot of sense to make sure the dependent care plan runs on a calendar year basis so that we can track. It makes tracking that $5,000 limit much, much easier.
Mhm. Mhm. Yeah, nobody likes to be told that they can't spend their money. So yeah, let's to avoid that. We got a good question asking about divorced employees, and a DCAP, and if between the two of them, are they still limited to that 5,000?
And the answer is no, because they're not married. However, that only one of them is likely going to be able to claim the $5,000 because it's the custodial parent who can do it. So while it's not so much that they're limited to 5,000, one of them is most likely not going to be able to claim it, and only one of them is going to get the $5,000 out in a divorce situation.
So in practice, yeah, only one between the two of them, they can only contribute up to
Right.
five.
Yeah.
But
Which is
it's
sometimes frustrating because the non-custodial parent might be ordered to pay daycare expenses, but then they can't use a dependent care account to pay for it because they're not the custodial parent.
We also have a question on FSA carryovers, and whatever the carryover is for the year, I think the important thing is just to realize that it's so for 2024 to 2025, it was 640, I believe, and that's how much you can carry over from the 2024 plan year to the 2025 plan year. Yeah, and that won't be prorated if there's like a short plan year.
It also doesn't count towards the 3,300.
Right.
So 3,300 is a salary contribution limit, how much you can deduct. But then there's a separate limit if you have a carryover, but it doesn't reduce the amount you can do through your salary reduction for the next year. And by the way, this assumes you as an employer have adopted a carryover. That's an optional feature. You don't have to do it. So it's got to be in the plan before it even becomes relevant.
Okay. Example, we'll get into HSAs. Maria works for employer A, who is a calendar year HDHP. Maria, who has never enrolled in HDHP coverage before, decides to enroll in self-only coverage for the 2025 plan year. How much can she contribute to her HSA for the 2025 plan year? 4,300, got the answer right down there in the contribution limits. She has single only HDHP coverage in a 2025 plan year, assumedly for the entire year. So she can contribute that full 12 out of 12 months, 4,300. Instead of enrolling at open enrollment, so we're still dealing with a calendar year plan, Maria adopts a child mid-year and enrolls in family level HDHP coverage as of April 1st, 2025. How much can she contribute to her HSA for the 2025 plan year? And if you'll recall, mid-year enrollees do have to be prorated for the HSA. We can see that in the monthly contribution rule. So looking at the monthly contribution rule, Maria will be HSA eligible for 9 months out of the 2025 year. And so that is the fraction that we then apply to the family level 2025 contribution for an answer of about 6,400. But with the full contribution rule, since she'll be HSA eligible as of December 1st, 2025 with family level coverage, she could contribute that full $8,550 for 2025 if she remains HSA eligible through December 31st, 2026. And I want to mention too, she doesn't necessarily have to maintain family level HDHP coverage through December 31st, 2026. She just has to be HSA eligible to be able for that full contribution rule to apply, and she can contribute that full $8,550.
Delaney, what happens if she doesn't maintain her HSA eligibility in 2026? What if she gets laid off, doesn't elect COBRA, goes on a traditional plan halfway through 2026 after having put in the full 8,550 in 2025?
Then she is going to get penalized. I'm going to assume the tax year's out, so she can't, she will have excess contributions for 2025, and assuming, we're past April 15th, she can't request a curative distribution to get herself back under the 6,400 number. So she's going to be penalized for that approximately $2,000 of excess contributions in her HSA. So it can be a bit of a gamble to rely on the full contribution rule. Like betting on yourself to stay HSA eligible for a year, for 13 months. So.
And I will say the penalty if you violate, if you don't maintain the coverage, sorry, somebody's joining us. The penalty if you don't maintain the coverage in 2026 is actually higher than if she'd over contributed just in the prior year. So yeah, you really do have to be prepared to take a gamble that you really think you're going to be able to maintain it for the entire next year.
All right. So sticking with HSAs, Maria works for employer A, who has a non-calendar year HDHP, a May through April plan year. She first enrolls for the 2024 plan year. So as of May 1st, 2024, she is HDHP eligible. Did I mention how much? And we'll say she enrolls in single coverage, to be clear. So how much can she contribute for that 2024 plan year that begins in May? And we decided to take it a little easy on you and give some multiple choice here. Could she contribute the full $4,150 for 2024? The 2025 maximum? Does it get a blended limit, or is it more concise than that with D? The answer is D. Because remember, even though the HDHP has a non-calendar year plan, HSA contribution limits are always measured on a calendar year basis. And so it can get a little confusing for non-calendar HDHPs because it also matters when the contributions are made. So for the 2024 portion of that plan year, she can contribute $2,766.67. Then for the 2025 portion, she can contribute $1,433.33. And I want to highlight that the 2,766 number is 8/12 of the 2024 of the 4,150. But she has to only contribute that amount for 2024. She can't just throw in 4,200 in, she can't front load her HSA because she's limited to 2,766 for 2024, the calendar year. That can be a bit confusing, but it just matters when she's making that contribution.
I'll say a couple of things when it comes to enrollments. When you've got non-calendar year plans like this, part of the difficulty is in most enrollment platforms, when you get to the part where it's asking how much do you want to put in your HSA, it depends on how your system is set up. It might be asking how much do you want per pay period, or it might be asking how much do you want for the year. Well, the system has got to program a limit. And so what limit do you put in? And very often it will default to in this example, the 2024 limit, because that is the correct number for 2024 on a prorated basis. But if it sticks to that, employees are giving up a certain amount of contributions they could make starting in 2025. And there's not really a good way to do that other than for employees to, if they're trying to max out for 2024, and then in January, go back in and change their HSA election, because they can change it at a minimum once a month, or more frequently if you allow that. And then up the contribution then for 2025 to take advantage of the now higher contribution limit for 2025. And we get a lot of these questions where people are trying to write benefit booklets and program their guides. They're like, well, no, just tell me what the number is for the 2024 and 2025 plan year. And the answer is D. There isn't one number. It is this much for 2024, and it is this much for 2025. That's just the way it is. It's always going to measure it on a calendar year basis.
Yep. Yeah, it cannot be expressed as a single number. Right. Mm-hmm. Exactly.
Okay, so we're going to talk about the special rule for married individuals here, as well as the catch-up contribution rule. So we've got Maria, who's HSA eligible. She and her children enroll in her employer's HDHP, so Maria has family HDHP coverage. Her husband, Sam, is also HSA eligible and enrolls in his employer's HDHP, but just him, so he has single coverage. And so the question now is, how much can Sam and Maria each contribute to their HSAs for 2025? And I'm sure Sam and Maria would love the answer to be, Maria can do 4,300, or Maria can do 8,550 and Sam can do 4,300. But unfortunately, that's not the answer. Because they're married, and at least one of them has family coverage, Maria in this case, they are limited to the family contribution limit of 8,550 split up between their two HSAs however they see fit. So they could put all 8,550 in Maria's. They could split it up between them. In theory, Sam could even put all 8,550 into his, even though he only has single HDHP coverage. His employer probably won't let him do that, but theoretically that's possible. But the point is that they are limited to 8,550. And somebody made the point earlier this year, unlike previous years, normally the single contribution limit is exactly half of the family, or vice versa, the family is double the single. That isn't true this year. Sam and Maria could actually contribute more if they each had single coverage than they can with one of them having family coverage for this year. Why is that? It's the formula that's in the statute. That's all we can say. Congress specified, here's how you calculate it, and we're stuck with whatever number it spits out. So that's the special rule for married individuals, is they are limited to that 8,550 divided between their two HSAs as they see fit. It is very specific to married individuals, by the way. If Sam and Maria were not married, if they were domestic partners, now in fact, Maria could do 8,550 and Sam could do 4,300. But because they're married, they're limited to the 8,550 combined. So let's then add in this additional fact. Let's say that Maria is 53, but Sam is 57. So 55 is the magic age to be able to make that $1,000 catch-up contribution. So Sam is in fact eligible to make that $1,000. Maria isn't there yet, so she is not eligible. So now how much can they contribute? Well, we've got the basic 8,550 for having family coverage. That remains the same. That base 8,550, they can distribute that however they want between them. Then Sam can make a $1,000 catch-up, but he can only put it into his own HSA. Maria can't put Sam's $1,000 catch-up into her HSA. So between them, they can do 95.50 for the whole year, but you can never have more than 85.50 in Sam's, or I'm sorry, in Maria's. Sam has to put his 1,000 in his. Maria then has to wait another 2 years, and then she can start putting 1,000 in hers as well. But this is the key point with the catch-up, is you can only put the catch-up in whoever is age 55 into their HSA. You cannot put your spouse's catch-up into your HSA. So if Sam didn't have an HSA in his employer's plan in the situation, for him to take advantage of that $1,000, they would have to go out and find a bank or credit union or something and open his own HSA there and make the $1,000 outside of payroll probably. But that is the key. I think a lot of people don't realize that they assume it's a joint account because they're married. There's actually no such thing as a joint HSA. It is owned by one person. It's whosever name is on that account. You can use the money to pay for your spouse's expenses. That's fine, but it's not your spouse's account.
Right. Hey, I think we got some good questions in the.
Do it. Maybe if I can just to reiterate, what if they're both over age 55? Then they each can make $1,000, but again, only into their respective HSAs. Maria's 1,000 has to go into her HSA. Sam's 1,000 has to go into his HSA.
Looking at these, oh, great question. Someone who is enrolled in family HDHP coverage for January, then changes to self-coverage in February. Then what you do, you actually do kind of the same thing. It's just apply that monthly contribution rule. So for January, they have family level coverage. They can contribute 1/12 of the family level 2024 contribution limit. Then I'm assuming the rest of it, let's assume it's a calendar year HDHP, make things simple. For the rest of the year, they have single level coverage, then they can contribute up to 11/12 of the single level contribution limit for 2024 and just add that together. So it's kind of a blended limit in that regard. Okay.
We have several questions asking about kind of the, where do these numbers come from, particularly as they change each year. We mentioned that for this year, the family contribution limit is not double the single limit. Somebody also makes the point, we keep getting higher and higher deductibles, but very often the max contribution limit is below what the actual deductible is. And why can't the IRS bump that number up? And again, this is actually the formulas for how those numbers increase are spelled out in the statute. And so the IRS really is just doing a number crunching activity. And they don't have the ability to pick a different number from whatever the formula that's built into the statute tells them it has to be. So most of the time it makes sense, but every once in a while we get a quirky year and we end up with, this isn't twice that. It just is the way it is.
Mm-hmm.
If you don't like it, talk to a congressperson. This is an interesting question. Is there a limit how much an employer contribute to an employee's HSA? So is there a maximum amount the employer can put in? Well, at least indirectly, the answer is yes. You can't go over the annual contribution limit. So as Delaney mentioned, both the employer and the employee contributions count towards that max contribution limit. So that annual contribution limit is the ultimate threshold. But as far as, beyond that, no, there's no restriction. If the employer wants to put the full annual limit in on their own, they can do that. Not surprisingly, you don't see very many employers do that, but you can. So up to that annual contribution limit, no, there really is no restriction on how much an employer can put into an employee's HSA. So if somebody wants to know who's actually monitoring all these DCAP rules and the maximums and blah, blah, blah. I mean, ultimately, it's the IRS. The employee is supposed to tattle on themselves. There is a part of the tax form you have to fill out when you're getting dependent care benefits. So if they get too much, or in the case of a divorced individual, if the wrong parent claims a dependent care account, they're supposed to tattle on themselves on their tax form. Now, does everybody do that? Probably not. But it is ultimately the IRS who's monitoring. Now, the employer doesn't have an obligation like the $5,000 limit. They can't deliberately disregard that and just start, willy-nilly handing out more than $5,000 in benefits. They do have to monitor that and try and make sure that doesn't happen. But again, like I said, with a married couple, you as the employer have no idea. If your employee elects $5,000 and their spouse elects $5,000, you don't know that. So you haven't done anything wrong in that scenario by paying out the $5,000.
Can an employee contribute to an FSA if their spouse contributes to an HSA? So if an employee enrolls in a health FSA, that means that they can pay for their spouse's medical expenses. The FSA is considered disqualifying coverage. So the spouse will no longer be HSA eligible. And so it'll affect how much they can contribute on their HSA. There's some timing questions that go into that, depending, whether the disqualifying coverage comes in mid-year or before the beginning of the year. But the FSA coverage would prevent contributions to an HSA overall.
Couple things on the FSA carryover limit, just to repeat the amount so going into 2025, the most you can carry over from an FSA from last year is $640.
Yep.
That number does change, so it is indexed for inflation, but at least for this year, it's $640. And then somebody had the question, is there a time limit to how long you can spend that carryover? And that's actually a plan design issue. You can actually write the FSA that either, you get the carryover into 2025 and you have to spend it by the end of 2025 or it's gone. Or you can write it that if you don't spend it, it will just keep carrying over year after year, as long as it doesn't go over whatever the annual carryover limit is. So you have to look at your FSA plan documents to see if it does say, give a deadline to which it be used by, or if it just carries over perpetually.
Mm-hmm. The question, what is the max HSA contribution when Medicare enrollment takes place in September? Well, Medicare is disqualifying coverage that if it's effective September 1st, 2024, then that means that they'll be HSA ineligible for September, October, November, December, 4 months. So they get to contribute 8/12 of the HSA contribution limit for 2024, whichever. And then you'd also prorate your catch-up contribution to Medicare enrollment. I'm assuming that they're at least 55. So that also gets prorated in that calculation.
I think it's worth pointing out too, notice that you cannot take advantage of the full contribution rule in that scenario.
Right.
So full contribution rule works if you gain HSA eligibility mid-year, but it does not work in this situation where you lose HSA eligibility mid-year, because you're not going to be HSA eligible on December 1st. So for people who are losing HSA eligibilities due to Medicare or whatever reason, they are stuck with the prorated contribution limit. And by the way, don't try to get cutesy and say, well, I'll just, I know it's 8/12, but I'm going to do 12/12 before I enroll in Medicare and then I'm good, right? No, it is not a when did you contribute limit. It's a how much did you put in limit.
Mm-hmm. I get the front load. And like mentioning, Medicare goes back 6 months when you enroll. Well, That'll depend on the facts and circumstances of the individual, and what it comes down to is you got to figure out their effective date of Medicare coverage, and that's, you know, when they'll start being HSA ineligible. So that's gonna vary person to person.
Yeah, and just be careful. Even Medicare says you should stop contributing to your HSA 6 months before enrolling in Medicare. That is only true if you enroll in Medicare after age 65. It is not true if you're enrolling in Medicare at age 65.
Right.
That's a way complicated topic. Let's, if
Yeah,
you
yeah,
have
yeah.
those questions, you know, talk to
Get
your
back to
broker.
annual limits.
That's a tough one. So,
Mhm.
um,
So yeah,
go ahead.
Yeah, so if you do need to prorate your HSA contribution amount, because you're, you know, enrolling in Medicare mid-year or otherwise losing HSA eligibility mid-year, you can still space out the contributions throughout the year. Again, it's not a temporal limitation of when you can make contributions. It's just lowering the annual limit. It does not matter when throughout that year those HSA contributions are made. Mhm. Just as long as they're staying within the limit, that applicable limit.
I think we're going to leave Jenny enough time to do her
Yeah.
final poll. So, Jenny, do you want to jump on and do that?
Great. Thank you guys. Great content today. Tons of questions. So I think it's just a reminder that even some of these things that have been around for a long time, there's just still lots of questions and confusion. So thank you, David and Delaney. Very much appreciated. Before we wrap up, I do want to ask our audience one additional polling question. I will get that launched here, so you will see that come up on your screen. Our topic for this question is mental health. And if you've joined a lot of our webinars throughout the year, you may recall we've asked several different questions kind of focused on employee well-being or specific to mental health. And we're now just curious, as you look ahead to next year, is your company implementing any mental health strategies? So please take a moment. You can select all that apply to your organization. And as you are submitting those responses, I will remind you, we did record our webinar today, and a link to the recording will be available early next week from the benefits advisor who invited you to this event. And if you have more questions, if we didn't get to your question or you want to kind of get more into the nitty gritty on anything that we discussed today, please also reach out to that benefits advisor who will be able to assist you. I'm going to let the poll sit up here for just another few seconds. We still have some responses coming in. Probably not a big surprise. EAPs are leading the pack here. EAPs are kind of the primary way that many employers are supporting their employees' mental health. But we're seeing some folks saying they're introducing maybe a mental health app, maybe some flexibility around time off, those sorts of things. But I'll let this sit out for just another second or two, and then I will share the responses back with you. Okay. So as mentioned, EAP is kind of leading the pack here, probably not a big surprise again, but a bit of a mix across other options. Certainly some of you just said no specific strategies, but a good mix there. And as always, we really appreciate your feedback on these polls. We do turn these into various deliverables and kind of write-ups. So if you're curious to explore how your peers answered these polls kind of further than what you see here on your screen, you can reach out to that benefits advisor for more information. But with that, this does conclude our time together. So thank you again for those Assurix Global partners for sponsoring today's event. Thank you, Delaney and David, and certainly thank you to our audience for spending your afternoon with us. Have a great day.